Welcome, everyone. Today's question is deliberately uncomfortable. Not are fintechs well-intentioned, but whether the systems we've built genuinely create financial inclusion or simply extract value from people with the least room for error. Before we examine today's fintech landscape, it's important to zoom out. Financial inclusion is not a new ambition. In fact, it's one of the most repeated promises in modern finance. Microfinance was supposed to unlock entrepreneurship at scale. Mobile money was supposed to leapfrog traditional banking. Neobanks promised fee transparency and fairness. Embedded finance promised access everywhere. Each wave genuinely believed technology would fix structural inequity.
And each wave ran into the same gravity: capital requirements, compliance costs, and the reality that serving low-balance, high-volatility customers is operationally expensive. The technology evolves, the tension remains.
This isn't cynicism, it's pattern recognition. Every cycle discovers that inclusion is not primarily a UX problem, it's an incentive problem. Let's say something that doesn't always get said out loud. Serving financially volatile populations is more expensive. Smaller balances mean less float. Irregular income means higher support needs. Regulatory scrutiny increases in underserved communities. Fraud risk can be higher in certain onboarding channels. If your margins depend on scale efficiency, this user profile breaks that equation.
And that's where the fork happens. Do you absorb the cost as a long-term investment in trust, or do you redesign the product so volatility becomes monetizable?
This is where intent meets math, and math is honest. Despite billions in fintech funding and massive innovation, the number of unbanked hasn't fallen nearly as much as we'd expect. So the question isn't, can fintech help? It's how and for whom it actually works.
From an investment perspective, this matters because the fastest-growing fintech models often depend on user volatility. That's not a moral judgment, it's a structural observation.
And abstraction is where risk hides. When infrastructure doesn't price trust correctly, the cost shows up downstream, usually borne by the most vulnerable users. One misconception I see constantly is that unbanked users are financially naive. In reality, many are extremely rational. They've learned, often the hard way, which systems punish unpredictability, and they opt out.
That rational avoidance is actually a signal. When millions of people choose not to participate, it tells us something about how risk and cost are distributed in the system.
We've all seen the language: democratization, access, empowerment. These narratives are powerful, and they're not fake. But narratives aren't business models.
The promise is real. Technology can lower costs and widen access. The problem is that promise alone doesn't pay salaries, infrastructure bills, or compliance costs.
This is where incentives matter. Many fintechs don't charge users directly, but earn through interchange, speed fees, subscriptions, or credit spreads. Profitability often scales with usage frequency and financial stress.
And to be fair, revenue itself isn't the villain. The issue is when revenue grows faster, when users are worse off. That's the tension we have to acknowledge. This is exactly why infrastructure choices matter. If your revenue model depends on user distress, your stack will quietly optimize for it.
Modern fintech is beautifully designed: notifications, instant access, seamless onboarding. But every reduction in friction has economic consequences. Push notifications increase engagement. Instant transfers increase fee tolerance. One-click access increases transaction velocity. Convenience is not neutral, it's monetizable.
And convenience often overlaps with urgency. If a user needs money immediately, they are less price sensitive. Systems that make urgency profitable will eventually optimize for it.
This isn't about blaming designers. It's about recognizing that design decisions are revenue decisions.
Venture capital operates on a timeline, 5 to 10 years, typically. That timeline rewards acceleration. Inclusion, however, is slow. Savings growth is slow. Credit repair is slow. Financial resilience compounds over years, not quarters. When capital demands hockey stick growth, products adapt.
This doesn't make capital bad, it makes it directional. If we want inclusion to thrive, we have to acknowledge that certain capital structures struggle to support slow burn resilience.
Speed is exciting, durability is quiet. Markets often reward the former. These examples aren't here to shame specific companies. They're here to show patterns. Many products start as no fee and later monetize urgency, convenience, or short-term cash gaps.
Infrastructure capital flows toward predictability, and unfortunately, late fees and short-term liquidity needs are very predictable.
Not all fintechs are extractive. Some genuinely improve outcomes, but they tend to grow slower, raise less capital, and face harder trade-offs.
This matrix explains a lot of market behavior. Venture capital is structurally biased toward the top right quadrant, high growth, high monetization, even if long-term user resilience doesn't improve.
When we talk about engagement, we rarely ask engagement with what outcome. More taps doesn't necessarily mean more stability.
As an operator, this is the hardest part. If you don't design guardrails early, growth pressure will quietly make decisions for you.
Up to this point, we've been talking about incentives in somewhat abstract terms: capital, KPIs, design, regulation. But there are industries where this tension stops being theoretical. Industries where volatility, compliance pressure, and user urgency are not edge cases. They are the operating environment.
High-friction industries, gaming, wagering, cross-border remittance, adult platforms, emerging regulated markets operate with compressed margins and amplified risk. In these sectors, fraud attempts are higher, regulatory scrutiny is constant, user behavior can be emotionally or financially volatile, payment failures are more frequent. And when you compress volatility and regulatory pressure together, weak incentives surface immediately.
This is why these industries are instructive, not because they're bad, not because they're reckless, but because they expose structural misalignment faster. In low-friction markets, you can hide weak infrastructure behind growth. In high-friction markets, the cracks show immediately. If your stack allows urgency to become revenue without guardrails, you'll see it here first.
Infrastructure doesn't just process payments, it encodes tolerance, what risks are acceptable, what behaviors are allowed, where is friction intentionally inserted. In high-friction industries, those decisions can't be vague, they must be explicit.
And that's the lesson. If inclusion cannot survive in high-volatility environments, it was never structurally durable to begin with.
In high-risk environments, monetizing volatility is often the fastest path to revenue. Urgency commands premium pricing, risk justifies higher spreads, friction creates fee tolerance. The math works.
And that's exactly the problem. When monetization and volatility correlate, systems naturally optimize for the thing that pays.
Strong infrastructure changes that equation. It doesn't eliminate volatility, it doesn't eliminate risk, but it changes where the cost lives. With weak infrastructure, risk is externalized to users. Compliance becomes reactive. Volume overrides restraint. With strong infrastructure, risk is priced intentionally. Guardrails are embedded by default. Certain monetization paths become harder, even when profitable.
From an investment standpoint, this is where differentiation actually appears. Anyone can scale volume in high-risk markets if guardrails are optional. Very few can scale while preserving durability. And durability compounds differently than extraction.
This is the part of the conversation most companies avoid, because extraction scales faster. Inclusion requires architecture. Architecture is slower, more expensive, less flashy, but it's also harder to unwind.
So if high-friction industries reveal the problem, they also clarify the solution. Infrastructure determines whether volatility becomes revenue or responsibility. Regulation rarely shows up at the beginning of innovation. It arrives after patterns emerge. BNPL scrutiny, earned wage access debates, interchange caps, data protection enforcement. These didn't appear randomly.
Regulation follows extraction. When monetization mechanisms scale faster than safeguards, enforcement fills the gap.
And infrastructure decisions determine whether regulation feels like friction or validation. If your system is built for durability, regulation confirms your design. If it's built for speed alone, regulation disrupts it.
Most fintech dashboards highlight MAU, transaction volume, ARPU, engagement frequency. What if those aren't the metrics that matter? What if we measured savings rate stability, fee dependency decline, credit improvement over time, reduced emergency borrowing?
What you measure becomes what you monetize. If stability isn't a KPI, it won't survive growth pressure.
This isn't a moral argument, it's a measurement argument.
If high-friction markets expose the problem, they also clarify the solution. Inclusion isn't about softer messaging, it's about harder architecture.
True inclusion aligns revenue with improved user resilience, savings, credit health, income smoothing. But those metrics mature slowly, which makes them hard to underwrite.
At Lock Trust, we've learned that doing this well means accepting lower short-term returns in exchange for durability. That's a strategic choice, not a slogan.
This raises a bigger question. Should financial inclusion be solved by venture-backed startups at all? Or does it require utilities, regulation, or public-private hybrids?
Markets are excellent at optimization, but only for what they're asked to optimize. If inclusion is the goal, incentives must reflect that.
The honest answer is sometimes. Many fintechs want the unbanked as customers. Fewer are structurally set up to want them as healthy, independent customers.
And that's not hypocrisy, it's gravity. Systems behave exactly as they're rewarded to behave.
That responsibility lives in infrastructure. If you don't design for trust, you end up monetizing its absence. The next decade of fintech will likely split into two paths. One path perfects frictionless monetization of volatility, faster onboarding, faster liquidity, faster revenue capture. The other path builds infrastructure that makes certain monetization behaviors harder, even when they're profitable.
Markets will reward both in the short term, but only one compounds trust.
Fintech's legacy won't be defined by who built the smoothest interface. It will be defined by whether financial health improved or simply became a new revenue stream. Whatever our intentions, our systems tell the truth. So the real question isn't what fintechs say about inclusion, but what outcomes they repeatedly produce. Let's talk. Thank you for joining us. Let's open it up, because this debate is just getting started. I want to open this up, and I'll say this up front. Disagreement is welcome. These are structural questions, not moral judgments. If something felt uncomfortable during the conversation, that's usually where the useful discussion lives. So let's explore some of that. Who wants to start? Gina, are you saying fintech shouldn't make money?
Not at all. Profitability is essential. The question isn't whether fintech should make money, it's whether revenue aligns with improved user stability. If profitability disappears when users become financially stable, that's worth examining. Revenue isn't the issue. Misalignment is.
So this really becomes the question of incentives, which leads us to the next one. Isn't this just how markets work, Jean-Marc?
Yes, markets and banks optimize what they're rewarded to optimize. The point isn't that markets are broken. It's that we should be intentional about what we're asking them to optimize. If resilience isn't rewarded, it won't scale.
So if incentives shape behavior, that raises the question of risk. Aren't high-risk industries just riskier by definition?
They are riskier, but risk isn't the villain. Unpriced or externalized risk is. Infrastructure determines whether risk is absorbed responsibly or pushed downstream. That's the distinction.
And sometimes conversations like this can sound like criticism of the industry, so let's address that directly. Is locked trust implying other fintechs are extractive?
No, most fintech teams are deeply mission-driven. They're more concerned with getting users than they are some of the core functions. What we're describing are systematic incentive pressure. Good people can operate inside the system that quietly optimize the wrong thing. We're talking about architecture, not morality.
So the real tension becomes this. Can a system be both inclusive and venture scale? Jean-Marc, can inclusion and venture scale returns coexist?
They can, but it requires discipline. It means designing products where long-term trust becomes a competitive moat, not a compliance burden. Fewer companies do that because it's harder.
That leads to a practical question. If you could change one thing tomorrow, what would you change if you could, Gina?
Well, I would change measurement. If the industry began reporting user financial stability as prominently as revenue growth, behavior would shift. What we measure becomes what we build.
Let's pressure test some of these ideas. We're going to move into a lightning round. Short answers, no essays, just clarity. Can fintech scale inclusion without monetizing volatility? Jean-Marc?
Yes, but only if revenues align with improved user stability. Otherwise, volatility becomes the easier profit center.
Gina, is no fee ever truly no fee?
Rarely, revenue always lives somewhere. Interchange data, float, credit speed. The real question is whether it's transparent or aligned.
Is regulation helping or hurting innovation right now? Jean-Marc?
Both. It slows reckless speed. It also forces infrastructure maturity. Long term, that's healthy. Regulation tends to follow visible harm. The more self-correcting infrastructure becomes, the less adversarial regulation needs to be.
What's the most dangerous KPI in fintech? Gina?
Engagement. If it's disconnected from user outcomes. More taps doesn't mean more stability.
Some people hear this conversation and say, this sounds anti-growth. Jean-Marc?
Growth and durability are not opposites. They just compound differently. The market may reward speed first. It rewards stability longer.
Is venture capital structurally incompatible with inclusion?
No, but time horizons matter. Inclusion compounds slowly. Capital needs patience.
Do high-risk industries expose weaknesses or create them?
They expose them. Weak incentives exist everywhere. High friction markets just make them visible.
What's more profitable, urgency or stability?
Net user financial improvement over time. If we measured that, behavior would shift.
What's one metric fintech should publish publicly?
That depends on infrastructure decisions being made right now. Systems don't drift toward ethics, they drift toward incentives.
Gina, will fintech's legacy be inclusion or monetization?
That depends on infrastructure decisions being made right now. Systems don't drift toward ethics, they drift toward incentives.
I'll leave us with one framing we started with. The purpose of a system is what it does. If we want different outcomes, we have to build systems that make those outcomes inevitable. Thank you for engaging in a difficult conversation.
Thank you, everyone.
Thanks, everyone.